Hello, everybody. I'm Kaya Özyürek, and it is with great pleasure that I'm hosting today Mr. Eric Basmajian. He is the founder of EPB Macro Research, and he does some top-notch analysis of the U.S. economy. So do make sure to check his posts out. And also, Mr. Basmajian has a special place for me. He is the very first follower of mine on Twitter, so I'm grateful for that. Today, we're going to be talking about the US economy and the financial markets. So, I would like to begin our discussion with the inflation rate. As you know, the current rate of inflation in the United States is at unprecedented levels. It rose above 5%, which is way above the Federal Reserve's long-term objective of 2%. And this has been caused partly by supply bottlenecks, supply chains, and partly by excess demand, which has been caused by rounds of stimulus checks distributed to people by the US government. So my first question is, how transitory is the current rate of inflation, and how long will it take for inflation to come back down to 2%?
Well, thank you for having me on. And it's been exciting.
It's a pleasure to have you.
It's exciting to watch your Twitter following grow over the past couple of months. Just to take a step back and set the stage in terms of inflation. My analysis, I consider two main timeframes. I look at what I call secular economic trends, which would be factors that influence economic growth and inflation on a 3-year or longer time horizon, something in the range of 3 to 5 years. Those factors would be mainly debt and demographics. But then I also consider what I call cyclical economic trends, which influence economic growth in the time frame closer to 6 to 18 months. Anything shorter than 6 months gets very difficult when using macroeconomic research. There's just too many factors that can influence monthly changes or quarterly changes. So the 6 to 18 month window is where you want to be if you're looking at cyclical economic trends. So with that said, what happened if we go all the way back to the beginning of the COVID pandemic was most of the global economy was shut down, which caused supply chains to be disrupted. And at the same time, as you mentioned, the government sent out stimulus checks. It wasn't just the stimulus checks, though. There was a behavioral component to it because people had to stay home. They weren't physically able to consume services, things like movie theaters or restaurants. So consumption, by nature of the stimulus, but also behaviorally, shifted radically in the direction of durable goods. There was a massive spike in durable goods consumption that likely would have happened with or without the stimulus, but the stimulus certainly exacerbated that issue. So we had a major spike in durable goods consumption as a result of the stay-at-home orders. And people had to sort of outfit their house with materials to last several months. Things like new desks for working from home, if they moved from the cities to the suburbs, all different types of durable goods like ovens, refrigerators, microwaves, etc. So
yeah, Eric, sorry to interrupt you, by the way.
Yes.
Speaking of durable goods, I remember this chart from the Fed which showed the average prices of the durable goods, and they have been coming down. They had been coming down for about 10 years, and they started rising after the beginning of the pandemic.
Exactly right.
As you've said, people change their preferences, and with the change of the preferences and with that excess demand coming from credit creation and stimulus checks, that was definitely unprecedented, especially after 10 years.
That's exactly right. So what we had was a shift outward in the demand curve into constrained supply. And when that happens, of course, prices rise. And that inflation aside, that also was the basis for a global manufacturing upturn, what we would call a cyclical upturn in the global manufacturing sector, because all of these durable goods had to be produced. There wasn't enough inventory in existing stock to facilitate all of the new demand. So this jump-started a global manufacturing rebound. And this was the basis for what the reflation trade was from basically the summer of 2020 through the summer of 2021. Around the summer of 2021, around May, June, there was an inflection point in growth. The growth rate of the economy in real terms started to come down, but the inflation rate stayed elevated. The inflation rate stayed elevated mainly because of supply chain bottlenecks. So the way that I calculate inflation or growth or any metric is generally what I call a smooth 6-month annualized growth rate. It's a little bit different than a year-over-year calculation, and I use that to negate some of the base effect. And the first thing to note is that the rate of increases in inflation have started to slow down. So based on the way that I calculate it, the inflation rate was about 6.4% in the June reading and about 6.5% in the next reading. So only about 0.1% sequential change. So there's already a bit of a slowdown in the rate of increase. The second thing to note,
it has decelerated. Can
exactly.
we say it has decelerated?
Okay. The rate of increase is starting to decelerate. The second thing to note is that one of the main reliable indicators of inflation are commodity prices, specifically the growth rate of commodity prices. As we're looking at the rate of change in inflation, we have to look at the rate of change in commodity prices. Commodity price growth peaked in April of 2021. So we've seen commodity price growth come down for several months. We've also seen the US dollar bottom around January of 2021. My preferred measure is the Federal Reserve's trade-weighted dollar index. So you would think if we have the commodity price growth coming down, the US dollar starting to bottom or strengthen, that would be two factors that would generally push the inflation rate down. And that's
especially
true.
The lumber prices.
That's right.
They had skyrocketed to extreme levels, and they have come down. And I think they contributed to higher home prices overall.
That's exactly right. So what we have now is a situation where main indicators of inflation are coming down, but the rate of headline inflation is remaining higher than these leading indicators would otherwise suggest. And that's because of supply chain issues. We know that these supply chain issues are starting to ease. One indication of that would be in the ISM report, the Institute for Supply Management. They publish a supplier delivery times index. And for the last 2 months, we've seen the supplier delivery times index edge lower, and we've seen a commensurate decline in the last month in prices paid. So in the manufacturing sector, broadly, they're starting to notice that some supply chain pressures are easing and the prices paid are coming down as a result. Now, there are still some localized supply chain issues that may take more time to resolve. The last factor I would mention that would suggest that we are probably right in the peak of inflation right now. We may have peaked last month, maybe we peaked this month. We're right at the peak because if you look at headline inflation, the way that I calculate it, we're over 6%. But if you take a Federal Reserve measure of inflation called the 16% trimmed mean inflation, what that does is it, on a monthly basis, it removes the top 8% monthly changes and the bottom 8% monthly changes for a more broad measure of inflation, removing some of the extremes. And on that basis, inflation is only about 3%. So when you take out the top 8% of components, the inflation rate drops 300 basis points. And why that's important is because that spread between headline CPI and the trimmed mean CPI is the largest spread we've seen over the last 20 years. So the concentration of inflation is very narrow. We have seen a cyclical rise, but the concentration that's causing the extreme numbers is very, very narrow. So given the fact that we have a narrow concentration of inflation, we have commodity price growth falling, we have supply chain pressure starting to ease, and then we also have the secular backdrop of excessive debt and slowing demographics, the case for transitory inflation is very strong. And I would suggest that by the end of the year, we'll see rates of inflation that are lower than they are today.
Yeah, I think measurement of inflation that you mentioned should be more accurate than the headline inflation. And watching Chairman Powell's press conference at the Federal Reserve, he has accentuated the importance of the reopening of the economy and the stimulus checks in the acceleration of the rate of inflation. I mean, with those effects fading away, I do believe that we're going to be seeing inflation rate come back down. And I think you've also watched the Jackson Hole meeting where Chairman Powell talked about the U.S. economy and the fundamentals of the U.S. economy. One of the remarks he made was due to demographics, the long-run inflation expectations will drift below 2%. I mean, in the past, I think like we had more younger people who bid up the prices more and more, but with the aging of the population, we're going to have less people who are going to be bidding up prices higher and higher. And you've also mentioned an important point, which is the debt dynamics. When you look at the developed economies, whether it is the Eurozone economies, the US economy, or the Japanese economy, you can see that those countries' private sectors have been excessively leveraged. I mean, I think, Mr. Ray Dalio has written a book about the debt crises. And one of the things that he talks about is this debt cycle where companies and households take on more and more debt. And eventually, at the end of what he refers to as the long-term debt cycle, that debt to GDP, private debt to GDP ratio will have already peaked. And that ratio will come down as people pay off the debt after the recession. The same thing we saw after 1933, and the same thing that we saw after the 2008 great financial crisis. So, as you've also said, the debt level is really unsustainable for the private sector in the US economy. And this is one of the things that has held back the private investment and private consumption as well. And therefore, inflation rate might remain below the Federal Reserve's target of 2%. So that's an interesting point of discussion. So let us move on to another economic fundamental, which is employment. We saw massive employment gains since last year's summer. And over this summer, actually, we've had massive gains as well. But unfortunately, last week's non-farm payroll data, I think it was a bit of disappointing. What would you say? Will we see massive employment gains over the coming months? Will we see employment gains decelerate? And what do you think has contributed to this low employment data for last week?
So that's a great question. So what I see going on in the US labor market is that we're going to be stuck with excess labor. And excess labor is going to make it difficult for wage gains to stick. And the reason I say that is because if you look at something like the employment to population ratio or the labor force participation rate, those have been in secular decline. And they declined, both of those metrics, fairly sharply after the COVID recession.
2008.
After 2008.
Especially after 2008. Yes.
Exactly right. And then again after the COVID recession, and they have yet to recover. And if you look at non-farm payrolls, the trend line that payrolls were on, we're still missing somewhere between 9 to 10 million payrolls against that trend. But if you look at the GDP trend, we have nearly closed the GDP gap despite the fact that we're missing so many workers. So what happened, and this is a dynamic that occurs frequently in recessions, is that in a recession, you pull forward a lot of productivity gains. The productivity of the economy, the aggregate economy, may slow when measured on a basis like GDP per capita. But if you look at GDP per worker, that ratio spiked, meaning that we're creating just as much GDP with a lot less workers. And that's the technology effect. That's the technology effect of recessions pulling forward gains in productivity. And what that generally means is that there is going to be a permanent loss of labor from jobs that were displaced. If you look at industrial production divided by the amount of manufacturing workers, what we see is that every individual worker is getting more and more productive. And this is the technology effect. But if we look at production per dollar or production per unit of wage, we see that that ratio is declining. So companies are going to be incentivized to invest in technology that displaces labor because they're going to get a much better return on technology than on their labor. So we're going to see a dynamic where companies are investing in technology for the sole purpose of getting rid of labor. And that's a very disinflationary impact of technology that stands in stark in very clear opposition to technology gains that increase the economy's capacity to use resources. So, for example, the invention of the car created a step function increase, almost forever in the amount of oil that we use, for example. But all of the technology today is focused on reducing the amount of labor that we need because labor is the most expensive component of that function. So I don't foresee rapid employment coming back after the unemployment benefits fade. There may be some increase of people that were marginally not working because they were getting generous unemployment benefits. But if we look at the economy as a whole and the gap of millions of people that have been displaced, we're not going to see 3 to 5 million people, in my opinion, all of a sudden come back into the labor force because companies have already figured out how to operate at the same GDP capacity with significantly fewer workers. And that's a trend that's going to accelerate going forward, not move in the other direction. So I actually foresee those employment to population ratios, those labor force participation rates, there'll be volatility on a cyclical basis, but over 10, 15 years, those are going to keep coming down.
Yeah, that was actually one of my questions. So thanks for answering that as well. I think I'd like to ask one more question about the employment data. Do you think we'll see a textbook-like wage price spiral over the coming months, depending on the employment data?
So I don't think we will. I don't think we'll see a lasting wage price spiral. And Chair Powell actually noted this in one of his speeches several months ago, is that we never, despite the extremely low unemployment rate of the last economic cycle, we never saw significant wage gains. And he cited the fact that the employment to population ratio was so low that every time the unemployment rate dropped and wages were about to rise, new people entered the labor force and kept the wages suppressed. So given the fact that those ratios are continuing to get worse, I would expect a similar dynamic. The second thing is that if you look at the real GDP, just the graph of real GDP in the economy, and you look at the trend line that was from 2009 to 2019, and you look at where we are now, including the third quarter,
significantly different.
We're still about 2% lower than that trend, inclusive of the third quarter's GDP. So that's a year's worth of economic growth that we're still missing relative to that trend. So we are going to have an economy that's rigged to handle much more production than we're currently using. That's the excess capacity. And most of that excess is in the labor. So I believe that that's a major factor that's going to keep wages lower, specifically in real terms. I would expect real wage growth to be no higher over the long term than the last economic cycle, and most likely lower.
Mm-hmm. I do agree with you. I think the long-term path of economic growth and inflation will depend significantly on credit creation, demographics, and other financial factors as well. I think we have gotten away from the Phillips curve type inflation, especially with the new technology, with the advent of new technology.
I would agree.
So My next question to you is, where do you see long-term treasury bond yields headed? Do you think they will reach somewhere close to 2% about the end of this year or perhaps next year?
So long-term bond yields will most often, if not always, move with the direction of nominal GDP growth. So the nominal rate of GDP growth, so if I say nominal GDP growth is 3%, that doesn't necessarily mean that long-term treasury rates will be 3%. But if I told you that nominal GDP growth was 4% today, and a year from now it was going to be 2%, so nominal growth was going to move from 4% to 2%, you can be quite confident that long-term treasury rates will follow that same direction. The magnitudes may be different from cycle to cycle, but directionally, we're going to, in my opinion, maintain a very strong correlation between the direction of nominal GDP growth and the direction of long-term bond yields. So given the first few minutes of this conversation, we outlined a long-term decline in the rate of growth and the rate of inflation. That's going to exert a significant downward force on long-term bond yields over the long term. Over the 3-year window, there's going to be constant downward pressure on long-term bond yields. From the summer of 2020 through the summer of 2021, during that cyclical rebound in global manufacturing that we mentioned, that reflation that we mentioned, bond yields were rising because the cyclical momentum in nominal GDP growth was higher. As I mentioned, that inflection point occurred over the summer that we're now in a growth rate cycle downturn. The cyclical momentum in real economic growth and soon to be the cyclical momentum in the rate of inflation are both going to come down over the next 3 to 6 months. Therefore, I would expect the bias for long-term bond yields over the long term to be lower and also over the cyclical term to be lower. So I don't typically work with point forecasts. I mainly am concerned with the direction. And given that I expect growth and inflation to move lower over the next 6 months, my bias would be for treasury rates to move lower also.
I agree. I mean, as you would also say, central banks exert a very strong command over short-term money market rates like 3-month treasury bills, 3-month commercial paper rates, or 3-month Fed funds futures. But what many people miss is that people think central banks can significantly alter where long-term treasury bond yields are headed. So, of course, central banks can affect long-term treasury bond yields, especially with the yield curve control, where the central bank pegs the yield to maturity of a bond of a given maturity. But what we saw in the beginning of the pandemic, around March 2020, as you remember, the 10-year treasury yield came down to around 0.4% or 0.5%.
I believe so.
That was due to economic fundamentals, declining investment, declining consumption. So market participants priced in the fact that COVID would have extremely damaging effects of the US economy, which would require long-term borrowing rates to be significantly lower, which in turn pushed down the long-term treasury bond yields. And of course, as you might also remember, after the beginning of March, around the 12th or 13th, we saw 10-year treasury yields prices come down and yields go up to about 1.1% because all financial institutions and corporations, like many of them, they were selling their bonds to get their hands on US dollars. And because there were many sellers and no buyers at all, the Federal Reserve had to serve the role of the what Perry Merling would refer to as the market maker of last resort. It bought up all those assets along with mortgage-backed securities. It fostered smooth market functioning. So that did contribute to rising bond prices and lower yields. But the thing that kept bond yields low, especially over the course of the summer of 2020, was the economic fundamentals rather than global central banks' asset purchase programs. And of course, because short-term interest rates and the guidance on short-term interest rates can affect the funding costs of primary dealers and the investment decisions of financial institutions, short-term interest rates can affect long-term treasury bond yields. And because commercial paper borrowing plays an important role in the US economy, lower short-term yield rates also mean lower bond yields, which mean lower borrowing costs and more demand-induced investment. So short-term interest rates can affect long-term bond yields in this sense, but short rates do not affect long-term bond yields as much as economic fundamentals do. So my next question is, how would you explain the transmission mechanism from monetary policy to risk assets, to stock markets, for example?
Right. So I think you did a great job, by the way, of explaining what I believe is a very overinflated view of the Federal Reserve's control of long-term interest rates. I think you did a great job of explaining that.
I appreciate your kind comment.
As far as the transmission mechanism from monetary policy to risk assets, given the fact that we're at the zero bound, the Federal Reserve has no price effect. They can't drop the short-term interest rate significantly. So what they're left with is basically balance sheet expansion. And I assume what we're talking about is the impact of quantitative easing on risk assets. And I think that there's a couple ways that you could arrive at a conclusion that quantitative easing could help risk assets. The first is that the principal effect, in my opinion, of quantitative easing after the transaction has cleared is that you're going to reduce the duration of the debt held by the private sector. So you're going to put, essentially, you're going to swap the private sector holding longer term securities for overnight deposits. And that removal of duration from the private sector could cause longer duration assets to increase in value if there's sustained demand from other private sector institutions for long-term risk-free duration. So I think that's one impact. The second thing is that if you reduce the duration of the debt held by the private sector, you'll slightly reduce the interest sensitivity of the economy. So if interest rates rise, the economy may not respond as negatively as if there was a ton of duration in the private sector. But to one of the points you mentioned earlier, given the fact that there's so much private sector leverage to begin with, we can't just focus on the treasury borrowing costs. The third factor I would mention is that when the Federal Reserve engages in quantitative easing and they buy a treasury bond from the private sector, the way the transaction typically ends is that the private sector now has a deposit, the banking sector has a reserve, and the Federal Reserve has a treasury. This was asked of Brian Moynihan on one of the Bank of America calls, which is if you're getting all of these new deposits in the banking system and it's not going to facilitate new lending, is that money just going to basically be recycled back into government and agency securities? Effectively, the loan to deposit ratio going down, where does all that extra money go? And it sort of just stays parked in various government and agency securities, which could have a dampening effect.
Asset swap.
Right. So it can have a dampening effect on the volatility there. The fourth and the primary way it may impact risk assets, and this is a detrimental impact to the economy that the Federal Reserve may or may not realize, is that this is something that Dr. Lacey Hunt, I believe he cited Kevin Warsh with the signaling effect is what it's called, in that private sector corporate managers have the choice to make an investment into the real economy or financial type investments, whether it be share buybacks or M&A or some type of financialized transaction. And when the real economy is not prioritized, but the financial economy is prioritized, corporate managers are going to shift more and more away from investing in real tangible goods that may be illiquid, that in a recession may have no bid. And in a recession, the Federal Reserve can't provide support to property and equipment. They can provide support to financial investment. So there's a strong signaling mechanism to the private sector that financial investments will be protected, while real investment may not be as protected. And there's risk associated with owning extremely illiquid property and equipment. So there's a large impact there of corporate managers shifting to more financial type investments, more buybacks, more simply issuing debt to buy back stock. All of those things could have an impact on risk assets, but that lack of private investment ends up having a very, very, very negative long-term impact on the economy. It doesn't show up right away because investment takes some time to change the standard of living. But over the last 10 years, such a reduction in private domestic investment is going to be something that over the next 10 years significantly reduces the rate in which the standard of living can grow.
Now, this also affects the income divergence, the wealth inequality across the U.S. economy.
That's right.
It's a really interesting point of view. My point on monetary policy, the transmission mechanism for monetary policy to risk assets, and especially in terms of quantitative easing, is like this. As you know, the Federal Reserve purchases these bonds from primary dealers, which are the market makers in government debt securities. And after the Federal Reserve purchases these bonds from primary dealers, the primary dealers obtain bank deposits at their correspondent bank, which is usually Bank of New York Mellon. And Bank of New York Mellon receives what we refer to as the reserve balances at its Federal Reserve account, the master account. So what the primary dealer will do with the new deposit creation is it's going to purchase government debt with that, because it has to participate in government debt auctions. But what it can also do is that it can use those newly created deposits and it can loan out in the repo market, in the collateralized borrowing market, to asset managers like hedge funds. So as primary dealers obtain bank deposits, they may opt for lending out their deposits at their bank to asset managers. The asset managers will find more funds in the repo market, whereby they will obtain the funds necessary to make leveraged investments in the stock market. So this is one of the aspects from which quantitative easing may affect risk assets. And as you've also said, if there is continuous demand coming for long-term treasury bond yields, and a central bank, let's say the Federal Reserve, purchases bonds at a very big scale, bond prices will go up, yields will come down. And as yields come down, the cost of equity of companies will also go down. As the cost of equity goes down, the present value of future cash flows of those private sector companies, will also go up in value, which will then increase the share equity value of these companies. So this is also one of the ways.
That's a great point. And if I can interject 1 second, I just want to make one point on that before I forget, is that we see a outsized impact of the phenomenon that you just described with a handful of companies, Amazon, Facebook, Apple, Google, for example.
They have risen, their stock prices have risen tremendously.
That's right, because in my opinion, the market perceives those companies to have extremely long-term, durable cash flows, almost with the security of something like a US Treasury bond. So a company like that will see the largest benefit if they have the longest duration cash flows of that effect we just talked about. Where if we look at a company like IBM, they've been doing aggressive share buybacks. They've been doing all of the financialization that some of the other companies have been doing, but they don't benefit at all because their organic growth and their long-term cash flows are shrinking. They're not growing. So you do generally need to have legitimate growth, and you need to have durable cash flows to benefit from this effect. But if you happen to be a company such as the big mega cap tech companies, that do have really long-term, really durable, really sustainable cash flows, even something like utility stocks, for example, those companies are going to see the largest benefit from that phenomenon that we just described. So that's where the market distinction gets very interesting, where you see such a fierce secular trend in the ratio of something like QQQ technology stocks to IWM Russell 2000, for example.
Mhm. And I was going to ask you about the stock market. What is your outlook on the stock market? How do you think stocks will trade? Will we see a correction? And looking at the comment section, somebody asks, does Eric expect a bear market, especially in an overvalued tech stocks in short or midterm?
So I'll try and answer both of those questions in the same answer. Going back to my secular and cyclical framework, and I have a video on YouTube for those that may be interested in some more detail called The Importance of Growth Cycles. If you Google my name and then The Importance of Growth Cycles, you'll find a video where I explain this concept. And what we see with the research is that when economic growth is in a cyclical upturn, so the growth rate is rising, let's say the growth rate in the economy is going from 0% to 4%, we're going to see risk assets perform better than defensive assets. So stocks will outperform treasury bonds, for example. Industrial commodities will outperform gold, for example. And within the equity market, the most cyclical sectors like regional banks, small caps, industrials, materials, all of those sectors will perform the best when the growth rate in the economy is rising. And this is a second derivative analysis, so it's the growth rate rising. However, when the growth rate is declining and you're in a growth rate cycle downturn, we see the opposite. We see long-term treasury bonds on average outperforming stocks like the S&P 500, and we see gold outperforming industrial commodities. And within the equity market, we see defensive or long duration equity type assets like technology and utilities relatively outperform these cyclical sectors like banks, Russell 2000, et cetera. So the growth rate in the economy peaked in March and April of 2021, and it's been declining since. And if we look at the last 6 months, what have we seen? We've seen regional bank stocks are down about 6%, and the Russell 2000 is about flat. It's up about 1%. But in the same time period, utilities are up about 6%, and technology stocks are up about 18%. So to answer your question about the stock market, I believe that the economy is going to continue in a growth rate cycle downturn. Now, we may not see a correction in the S&P 500 because technology stocks may carry the index higher. But if we look under the hood, this would be the time period that I would expect corrections in cyclical equity sectors relative to the broader market. So I would be on the lookout for things like regional banks, Russell 2000, materials, very cyclical, inflation-sensitive, growth-sensitive sectors of the economy. So I don't want to say that I expect a 10% plus correction in the S&P 500 because if growth comes down and treasury rates fall, things like QQQ and utilities may get a lift from the interest rate effect. But sectors like regional banks, industrials, Russell 2000, materials, I would expect some weakness to continue. Weakness that we've already seen over the past 6 months, I would expect that to continue. And you'll have to remind me of the comment question. I forgot the question.
Yeah, somebody asks, what about the precious metals? What will be the near-term future effect on gold and silver?
So when the economy is in a growth rate cycle upturn, silver tends to outperform gold because silver has a little bit more industrial use than gold. But when the economy is in a growth rate cycle downturn, silver dramatically underperforms gold. And again, since that inflection point over the summer, we have seen silver underperform gold. So moving forward, I would expect the way that I try and look at relative performance. So if I look at the commodity space in general, gold, silver, and a broad basket of industrial commodities, over the next 6 months, I would expect gold to relatively outperform silver and industrial commodities.
Yeah. And I don't want to deviate from this topic that much. So I'm going to take one question from the upper section of the comment section. Somebody has asked earlier, what do you think about cryptos and how do you think cryptos will affect the US economy and the world economy?
So I don't have much of an opinion on cryptocurrencies. I will take this question and move into central bank digital currencies because I think that's the closest approximation to the work that I'm doing. And I believe that you've talked about this at length in previous interviews that you've done. And this would be one factor that would radically change my outlook, both long-term and short-term, would be the introduction of what I would consider a true modern monetary theory. We have this notion right now that large fiscal spending or large deficit spending is modern monetary theory. And that's just not true. All we're doing is large deficit spending. That's all it is. In my opinion, if we change the paradigm in which we're operating, in which the Federal Reserve can directly grant money, spendable money to people's checking accounts in the form of a central bank digital currency, that has the potential to be extremely inflationary, but that would change the monetary structure and the economic system in which we're operating altogether. So I do believe that is a huge jump. I don't think we're there yet. I think that would take a long time to happen, but something like a central bank digital currency would be something that would concern my overall disinflationary outlook. Unfortunately, I don't have too much of a direct opinion on the various cryptocurrencies, but that's my take there. I know you've done a lot of work on this.
Yeah. And by the way, two people have asked, do you expect a stagflationary environment in the United States?
So I think that the environment that we've had over the last 6 months, you could characterize as stagflation. To me, stagflation would be the real growth rate coming down, but the inflation rate rising. And that has been the dynamic over the past 6 months. If we look at real economic growth, and I would define real economic growth on a monthly basis, I have an index, what I call a coincident index. The coincident index is a equal weighted composite of industrial production, real consumption, real income, and employment. So those factors taken together, if you look at the growth rate peaked in March of 2021 at about 7%, and it's come down to about 4.1. So the real growth rate has been empirically declining. There's no debate about that. Over that same time period, the rate of inflation has risen. So you could characterize the last 6 months as stagflation. Over the next 6 months, however, based on the leading indicators that I look at, the real growth rate will continue to come down, but it will also be joined by the inflation rate that's going to come down over the next 6 months.
But it will be, So my take on this stagflation thing is, I mean, for there to be stagflation, I think there has to be negative growth over consecutive quarters. And what we are seeing right now is supply not being able to respond to excess demand. I mean, this has pushed prices higher, especially the prices of essentials. And the fact that the prices of essentials have risen, it has created an income effect, where people who are living on low incomes, they have to spend a significant portion of their budget on necessities. And because they will be left with less money, they will be able to spend lesser and lesser money for goods and services, which should drag lower the real growth rate of the economy. So that's my take.
The second point I would mention on that as well is going back to what we mentioned earlier, which was the surge in durable goods consumption. So durable goods, things like desks, ovens, microwaves, refrigerators, cars. In economics, there's a concept called pent-up demand, but you can also exhaust pent-up demand, meaning that you're not going to buy 3 ovens or 6 refrigerators. Once you have one, and you generally have one for quite a long time. That's why they're durable goods. So we saw
Chairman Powell has also talked about this, the pent-up demand aspect.
Exactly. So we've seen a couple things. One, there was a large surge in durable goods consumption because of the stay-at-home orders and the fiscal stimulus. There also was a major rise in durable goods consumption because of housing. In the United States, we had a once-in-a-generation demographic shift of people moving from cities to suburbs. That caused a large increase in the number of housing activity, and that causes you to furnish an entire house with durable goods. So there were 3 or 4 competing factors that all served to push durable goods consumption higher. But since they're durable goods that are subject to the concept of pent-up demand, what that really means is that we've pulled forward a lot of durable goods consumption from the future. So the next 2 to 3 years, we're going to see a sag in durable goods consumption that's going to have a depressing effect on those same goods that just rose in price.
Yeah. And so let me ask you one question about the, wait a second, please. Oh, yeah. So a lot of people think that a potential tapering program may have a significant impact on markets. So when do you think the tapering program will be announced? When will it actually start? And when will it end?
So up until the jobs report, I think it was a widely held consensus view that the Federal Reserve is going to announce the
July.
start of a tapering program in September. Then the weak jobs report came out, and now that is up for debate. I still believe that they will announce the start of the tapering program at their September meeting later this month, a program to begin likely in November or December.
Absolutely. That's what I think as well.
It's difficult to say exactly when it will end, partly because it depends how severe the cyclical downturn in the economy is by then. But the one point that I would make is that in a highly indebted economy, the Federal Reserve can always tighten monetary policy. If you tighten monetary policy in a high debt economy, the growth rate will slow, no question about it. But in a highly indebted economy, the Federal Reserve cannot always ease. They can try and ease policy, but the growth rate may not respond. It's called a liquidity trap. And this is the asymmetric nature of a highly indebted economy.
What happened in Japan?
Right. So the critical point here is that the growth rate in the economy is starting to come down. We're starting to see the fiscal stimulus wear off. We're starting to see diminishing marginal returns of government spending kick in, and we're seeing a general hangover of durable goods consumption. So the growth rate's coming down. The growth rate of inflation is going to start to come down. And the Federal Reserve is going to try and incrementally tighten monetary policy into a decelerating economy. And generally, that does not work very well for the Federal Reserve or for asset markets.
That may also push down the long-term yields as well.
Exactly. Prior to the jobs report, every time there was a bad piece of data, or every time the Federal Reserve was hawkish, saying that we're going to start the tapering program, long-term bond yields, as you mentioned, actually went down and the yield curve flattened in response to tighter financial conditions. So if the growth rate in the economy continues to come down, which I expect it will, and the Federal Reserve does try and engage in a tapering program, even though it's still buying bonds incrementally, it's in the tighter direction. It's not easier, it's tighter. So I would expect that we would see a similar dynamic in that the long-term bond yields will come down, the curve will flatten, and the program will exist only as long as I think the equity markets behave. I think that the Federal Reserve is quite focused on the financial markets, but the risk of a correction in the equity market is significantly higher when the growth rate in the economy is declining. And when you couple a declining growth rate with a tighter Fed, that is generally a recipe for cyclical equity weakness. So I will suggest that they'll start the program this year, and it's open-ended if they complete it. I don't think they will be able to fully complete the program that they're going to outline.
So I think it was around March when Chairman Powell said this. He said something in the lines of the Federal Reserve will announce the tapering program well before the start of the tapering itself. So despite last week's disappointing employment data, I do believe that the Fed will announce a tapering program this September. I think it may start on either November or December, of course. And as you said, it's really hard to predict when the tapering, when the asset purchases will cease altogether. It's quite hard to predict that. And I've seen Mr. Kaplan say that the tapering program should conclude by around March or April, something like that. So it's a very interesting discussion. We still do not have an answer to it, but we'll closely follow what the Federal Reserve says in this regard. So from the comment section, I can see two questions about the reverse repo facility. one of the questions asks, what do you think on RRP increase in Fed balance sheet? And the last question asks, reverse repo exploded. How long can the Fed sustain that trend line?
So I don't think the Federal Reserve has a fundamental problem with the reverse repos going higher. I think that they put that facility in place to do exactly what it's doing, and I think the general crux of the problem is that through fiscal stimulus and quantitative easing, the banking sector has been flooded with deposits. The bank balance sheets have grown in an environment where banks are heavily regulated in their ability to grow. And as a result, they're trying to push deposits generally towards money market funds, which invest primarily in short-term treasury bills. The short-term treasury bills were in scarce supply because of the TGA running down and the debt ceiling. As a result, there weren't enough T-bills for the new money that was flowing into money markets. And what would have happened is that short-term interest rates probably would have traded into negative territory. Optically, I don't believe that the Federal Reserve wants that, so they put in place this facility to essentially create synthetic T-bills for all of this capital. If the debt ceiling is resolved and Treasury issuance resumes again, and there is a flood of Treasury bill issuance, I would expect the reverse repo uptake to slow. And in addition, if they do taper the pace of quantitative easing, I would also expect that to reduce the uptake of the reverse repos as well. I don't fundamentally believe it's a huge factor for the cyclical direction of the economy. I think it's mainly a monetary plumbing issue. I would find it difficult to ascribe a direct correlation between the uptake in reverse repos and some fundamental change going on in the economy.
I do agree with you. I mean, the thing that increased the reverse repo usage is the collateral shortage. With credit creation and the rounds of stimulus checks, the amount of deposits in the banking system in excess of the insured amount has grown significantly. So that money poured into risk-free asset, which is the short-term that money poured into money market funds, which then invest in short-term US government bills. And because there was a lack of government bills, government bill prices went up, yields came down. And as you've said, we also saw government bill yields dip below zero. They were trading in the negative territory. And money market funds, which weren't willing to invest at negative rates, they decided to invest in the RRP. But then arises the question, why can government bills trade in the negative territory? That's because not all money market funds are eligible to earn the RRP rate, so they are required to invest the proceeds, their bank deposits, in government bills, which pushes down short-term treasury bill yields and also pushes down repo rates as well. And this entire phenomenon pushes down LIBOR rates and commercial paper rates, and this can also affect the financial system as well. But as you said, this doesn't have anything to do with the economic fundamentals. This is all about the financial plumbing. And so I would like to move on to our last questions, and I would like to combine a question from the comment section with my last question as well. This person asks, what does Eric think of the interest rates? Because it seems like the Fed needs to save the economy, constantly save the economy. And what is your take on the junk bond market? I mean, especially on the Asian side, we've seen some companies heading into trouble in terms of their US dollar denominated debt, and their debt has been reduced to the rating of speculative, to the junk rating. So this may create a problem for the financial system. What is your take on this?
So to take the first part of the question, when the economy historically has run into a recession or a major cyclical downturn, the last several times the Federal Reserve lowered short-term interest rates about 400 basis points on average. The problem this time is that in 2018, the short-term rate only got up to about 225. And then there was a cyclical downturn before COVID. A lot of people blamed it on the trade war. It really had almost nothing to do with the trade war. It was a cyclical downturn that was in the works long before the trade war started, but the Federal Reserve had to cut interest rates in 2019, long before COVID. So they cut interest rates, and then the economy started to level off. And right before COVID, there were actually some early signs that the economy was going to start improving, but it was a little bit early to tell. But then COVID happened and the economy shut down, and the Federal Reserve only had limited ammunition to lower short-term rates. So the short-term interest rate was only able to come down about 200 basis points, even if you take the previous cycle also. And this is relative to about 400 basis points in previous recessions. So right off the bat, the Federal Reserve was not able to engineer an environment that was as easy as they were in the past. And what they have to resort to is the balance sheet. The problem is the balance sheet does not have the same economic impact as lowering the short-term rate. So you can make a very strong case, and I would make the argument that the short-term interest rate in the economy is too high. It's too high because in a normal recession, they would have generally had to lower them about 400 basis points. So the fact that they were only able to lower them about 200 basis points in what was a very
limited effect.
Had a limited effect. And then they had to try and rely on the balance sheet. And they have all these metrics called like the shadow Fed funds rate and what the implied Fed funds rate is if you take the Fed funds rate plus the balance sheet. I don't believe that has the same economic impact. So it may sound surprising, but I believe that the short-term interest rate is probably too high for the level of public and private sector debt that the economy is carrying. In terms of the junk bond market, I'm not as familiar with the dynamics that impact the junk bond market, particularly the overseas junk bond market. I would default to my cyclical analysis, and I would suggest that during periods of economic acceleration, when the growth rate in the economy is increasing, like July 2020 to July 2021, a cyclical upturn, that junk bonds would relatively outperform. And I would expect that we would see continued cracks in the junk bond market so long as the growth rate in the economy is decelerating. So I would use my same cyclical analysis that applies to generally all risk or safe assets, is that when the growth rate in the economy is decelerating, and this is a global issue, the global growth rate is coming down, it's not uncommon to see problems in the junk bond market.
Yeah, apart from that, I also think the backstop, the implicit or explicit backstop from governments and authorities also play a very significant role in the junk bond market. So we still have a few minutes, and I'd like to take this last question. Will there be a change in the supply chain after COVID-19? Will states take broad steps to diversify their supply chain? And what does Eric expect?
I would say that there's almost no chance of supply chains coming back to the United States. The amount of money that companies would have to pay per unit of production would drop rather significantly. And mathematically, it is extremely unlikely to see supply chains come exclusively to the United States. So I would suggest that would be a very low probability. I think that there's some probability that they may see some stuff move out of China, but I think that it would move to other Asian economies. So I don't foresee that impacting the global, or at least the U.S. dynamics very much. It would just be moving from one country to another, because the economics of reshoring the supply chains exclusively to the United States just are not quite feasible.
Yeah. I think we all can agree on the fact that the post-COVID economy, I mean, thinking about entire global economy, will be significantly different than that of the pre-COVID economy. I think we all can agree on that. So I think this marks the end of our live discussion. I would like to thank you for being with us today. It has been a great privilege and honor and a pleasure to be directing you questions. We've had a very fruitful discussion on the U.S. economy, the path of the U.S. economy, inflation, employment, and on the markets. So thanks so much, everyone, for joining us today. And we'll see you later.
Thank you.
Thank you.